So if you've ever been named an executor or a trustee for someone, you know that feeling. It's a huge responsibility, and frankly, it can be pretty overwhelming. Well, today we're going to demystify one of the most important tools you'll need to master, Form 1041. That's the tax return for estates and trusts.
Let's just start with this one simple question. What happens when an inheritance actually starts earning its own money? You see, after a person passes away, their estate doesn't just freeze. The savings accounts are still earning interest, stocks are paying dividends, maybe there's a property generating rent. All of that new income has to be reported to the IRS, and that is exactly what Form 1041 is for.
And this really gets to the heart of it. You're probably used to Form 1040 for your own personal taxes, right? Well, just think of Form 1041 as the estate's version of that. It's the official income tax return for this brand new temporary financial entity.
Okay, to make this all super simple, we've broken it down into 5 clear sections. We'll start with what your new role actually is, then we'll break down the form into 3 big questions, clarify the difference between an estate and a trust, talk about the crucial K-1 form, and then we'll finish with some practical steps you can take right away.
First up, let's talk about you. Taking on this job can feel pretty daunting, and that's completely normal. Our goal here is to help you shift your whole mindset from feeling overwhelmed to feeling empowered in your new role as a fiduciary.
Now, I absolutely love this analogy. It reframes the entire role. You're not just some person handling paperwork. No, you are the temporary CEO of this entity. That means you are in charge. You're managing the assets, you're paying the bills, and you're making sure the taxes get handled the right way. It's a real position of leadership.
So that CEO role, it has a legal name. You're a fiduciary, and that word is all about trust. As a fiduciary, you have a legal duty, a serious one, to act in the absolute best interest of the estate or trust, and of course, its beneficiaries.
All right, let's dive into the form itself. Now, instead of getting lost in all the little lines and boxes, we can pretty much understand the whole thing by breaking it down into just 3 simple questions. The first question is pretty straightforward. Just like with your personal taxes, the form starts by asking about all the income. We're talking about interest from bank accounts, dividends from any stocks, and any capital gains if you had to sell assets like a house or some stock for a profit.
Next up, the form asks about deductions. This is where you get to list all the costs of managing this thing. And importantly, this includes any fiduciary fees for your own work, plus payments to the pros you hired to help, like lawyers and accountants. And here's where a 1041 gets really unique. The form's last big question is, where did the leftover income go? This is handled through something called the income distribution deduction. Think of it this way. If the estate earns, say, $10,000, and you distributed that same $10,000 to a beneficiary, the estate can deduct that amount. Why? Because now the beneficiary is responsible for reporting that income on their own tax return. It's a clever way to make sure that same dollar doesn't get taxed twice.
Okay, so now you get the logic of the form. But, and this is a big but, how you actually fill it out depends entirely on the type of entity you're managing. So let's quickly break down the most common types.
Okay, let's look at this table. First up, a descendant's estate. This is the most common one you'll see. It's temporary, and it just exists until all the assets are passed out. Then we have trusts. A simple trust, well, it's pretty much what it sounds like. It has to distribute all its income every single year. You're basically just a pass-through. A complex trust, on the other hand, gives you more flexibility. It can hold on to some income, which can be useful for long-term tax planning, or maybe if the beneficiaries are kids and you want the money to grow for them. Knowing which one you're dealing with is an absolutely critical first step.
Now let's talk about what might be the single most important document that comes out of this entire process. We're talking about the Schedule K-1. This is the piece of paper that connects the estate's tax world to the personal tax returns of the beneficiaries.
So let's be crystal clear about this. As the fiduciary, the CEO, the executor, the trustee, you are the one who is responsible for preparing and filing the main Form 1041 with the IRS. And from that Form 1041 that you filed, you then generate a separate Schedule K-1 for every single beneficiary who received any income. This little document is their golden ticket for tax time.
Honestly, the best way to think of the K-1 is as a personalized report card. It tells each beneficiary exactly what type and what amount of income they need to put on their own Form 1040. It breaks it all down for them. You got this much in dividends, this much in capital gains, so they can file their personal taxes correctly and without any guesswork.
All right, we've covered a lot of the theory. Let's wrap up with a simple, actionable playbook. If you find yourself in this role tomorrow, what are the very first things you need to go do?
First, I want you to burn this number into your brain. $600. $600. If the estate has a gross income of just $600 or more for the tax year, you are legally required to file a Form 1041. That is a super low bar, which means most estates that go through the legal process of probate are going to need to file at least one of these.
So, your first moves are clear. Step 1, check if you hit that tiny $600 income threshold. Step 2, and this is a non-negotiable top priority, apply for an employer identification number, an EIN. You cannot use the deceased social security number. The estate is a whole new thing and it needs its own tax ID. Then, step 3, start gathering up all the key documents like the will and any income statements you can find.
And finally, a simple reminder. Don't forget the deadline. Just like your personal taxes, for most estates and trusts, the filing deadline is good old April 15th. So make sure you mark that on your calendar.
So let's just end with this thought. Form 1041, it isn't just a bureaucratic hurdle you have to jump over. It's a fundamental tool for carrying out your duty as a fiduciary. It's how you transparently and legally manage the financial life you've been entrusted with. So the real question is, are you ready to use it to honor that trust?